What's up everyone, and welcome to today's new video, where in this one we're looking at fair value gaps, what they actually are, how we navigate them, and then how we use them for entries. So starting things off, you can see I have a depiction here of a fair value gap. Now a fair value gap is a 3-candle formation. As you can see in this bullish example of a fair value gap, you see we have one candle, second candle, and then the third bullish candle. Now between these candles we have the wick of the first one, and then a second bullish candle straight through, and then the wick of the third one, and then the third candle straight through. Now these are all bullish, and we take the high of the first candle to the low of the third candle. Between the high of the first candle and the low of the third candle, we have a small gap inside here which trades through with the second candle. Now from this low to this high, that becomes our fair value gap. In the bearish example, you can see we have the first candle which trades low, the second candle which trades lower, and then the third candle which trades through the second. Now again, we take the low of the first candle in this instance, and then the high of the third candle in a bearish example, and then between these two we have a gap. So now that we know what a fair value gap is, we will dive into the chart and show you some examples of these fair value gaps used. Now let's go through some examples of fair value gaps and how they are used. So as you can see, we have price action here on the 15-minute chart on Euro USD. So we have failure swings all around here, which is low resistance liquidity, and then we take liquidity below here. Sell side liquidity is taken, we have displacement to the upside, and then between here you should notice something inside here. It is again what I spoke about. We have the fair value gap form between the first candle's high, the second candle trades through, and then the third candle's low. In a bullish example, this gap in between here becomes our fair value gap. Now as we are looking for buys, I would place my limit just below the third candle's low, target these highs, and then for stop loss placement on fair value gaps. Now this is important for your notes, note this down. For stop loss placement, you can either place your stop loss at the body of the first candle in the bullish formation, the body of it, or, which I prefer to do, at the swing low which starts the fair value gap. So as you can see, we have a swing low here, and then the 3-candle formation which forms our gap. You can put your stop loss below there and then target highs up here. For this example, I'll put my stop loss below the body of the first candle in the formation. So if this was a bearish fair value gap, our stop loss could go at the first candle in that bearish example. So let's play this through. As you can see, we don't get wicked out just because of the body. Now the bodies are where the real volume lies inside the market, so that is why in this example you can see that our stop loss did not get violated, as this candle's body did also not get violated. Price didn't want to trade through there as it didn't need to. We wicked into the fair value gap and then ran towards our take profit. Now showing a bearish example of fair value gaps used, you can see we have a low here on Nasdaq. We have a low and then we have displacement lower. Within this 3-candle formation, remember we take the first candle's high when bearish, extend that out in time, the second candle trades through, and then the third candle's high here, we take and extend it out. So in between the 2 candles low and high, this gives us our fair value gap zone, which is our entry zone. So we take our entry there. Stop loss can go above the body of the first candle, and in this case it goes here, or above the wick of the third candle, and then alternatively the swing high. In this example, I'm going to use the body, and we're going to target the sell side liquidity down there. You see price trade into the fair value gap, and I want to point out something here before we keep replaying. I want to point out how we came into the fair value gap, and then remember earlier I told you the bodies of the candles are where the real volume lies. So we closed inside the gap, which is a signature in price we want to see. And then notice how this candle here, if I move this out the way, this candle here trades above the fair value gap. As you can see, the grey box is our gap. We trade above it with the wick, and then the body closes inside the fair value gap. So we come outside it and then close inside. This is a great indication that the gap is actually going to hold and you shouldn't pull the trade. If we replay it on and actually extend our trade out in time, you can see that we smashed the take profit with one big candle straight down. So remember what I said, the bodies show the real volume of the market, we close inside the gap, and that is a signature in price which tells us the fair value gap should hold and head in our anticipated direction. So next I want to take you down into an example of how we use the fair value gaps as an entry, and actually how we can use a larger or higher time frame fair value gap and then go down into a lower time frame and use one of those ones on that low time frame to actually get a better risk to reward. So on GBP USD, you can see that we have sell side liquidity resting below this candle, and then between these three candles here we have the low of the first candle, the high of the third candle. We take the gap in between there and use it as our fair value gap. As you can see, we still have the low intact. We trade into the fair value gap, and now we're going to drop down onto the 1 minute time frame to try find a better, more refined entry to give us a better risk to reward. Now, as you can see, we're on the 1 minute chart on GBP USD again. This grey box, remember, is our hourly fair value gap. Now, as you can see, we head into the gap, and then on the 1 minute chart we get a leg lower. If you look inside here, we have something between these three candles here. We take the low of the first candle, extend it out in time, and then the high of the third candle and extend that out in time. And as you can see, whilst inside the 1 hour fair value gap, you can see that we actually form a 1 minute fair value gap after displacing lower. So now we anticipate this gap to hold, and as you can see, we create a low, trade into the gap, and then trade away from it. We trade back into another tap for the 1 hour gap and then trade below. And if you take your eyes to this price action after trading from the 1 minute gap up here, you can see we have equal lows here and an original consolidation. So if you take your eyes to this bit of price action here, you can see that the low of the first candle we trade through, and then we have the high of the third candle. If we take that out in time again, draw it with a box, the fourth candle wicks in, and bear in mind this doesn't have to be the fourth candle, but sometimes it will wick in and then quickly run away. As you can see, that's the first entry. We trade around a bit, break lower, and then trade into another fair value gap. That is the second entry before heading lower with massive momentum, past this consolidation in these lows and then past these lows. So this is how we use a higher time frame fair value gap like the 1 hour chart or the daily chart, and then head down onto a 1 minute or 5 minute chart. Look for price to create a fair value gap on that time frame, and then we can enter off that time frame, giving us a better risk to reward than if we just entered off of the 1 hour chart. Now I want to show you how we can use 50% of a gap. If we measure it, we can use 50% of a gap to tell us whether or not the gap should hold. So you may see this referred to as the CE of a gap, which stands for Consequent encroachment. Now if you take your eyes to these three candles here, you can see we have a fair value gap between the low and the high of these candles. If we extend that out in time with our grey box, you can see the price runs into it and then runs away. But I want to focus in on something within this price action here. If we take our Fibonacci tool and then measure the gap from the first candle's high to the third candle's low, you can see we have our 50% level. And now I want to point something out, how once we expand and then come back into the gap, we run really deep into the gap. Now this might scare you out, however notice how this 15-minute candle closes. We tap into the 50% and past it, but into the 50% is what we're focusing on, and then price actually offers buy side and closes above the 50% level. Now this is another signature in price I talk about, where we trade through the gap's 50% level or consequent encroachment and then close outside of it. This gives us an indication that the market does want to move higher, because of course the bodies is where the real volume lies. Now this can happen on bearish examples here. If you take your eyes here, we have a gap inside this bit of price action, and if we measure it out in time, we take the low of the first candle and then the high of the third. As you can see, we actually do tap past the 50% level, but then close outside it, and then tap it again, but close outside it. Now this time we closed outside the full fair value gap, which is a better indication that we are actually heading lower to clear out the lows down here. This is how we use the consequent encroachment of a gap to give us more indication that we are on the right side of the market. Now the final thing I want to teach you in this price lecture is an inversion gap. So If we look at this bit of price action here, you can see that we trade into an order block, expand higher, trade into this fair value gap, and then expand upside. Then we break lower and leave a gap inside here. Now you may be thinking price should return to this gap inside here before heading lower again. But notice how we don't. We trade past this imbalance and then it looks like we actually continue lower in a random place. However, this is not a random place and I want to teach you how we can recognize this. So this gap over here, which I first mentioned, is used for buying on this side of the market, as you can see before the run up. However, if we extend it past the actual initial run up and then leg lower, you can see that once we return up into the gap, which was once used for buying and is now being used for selling. So once we break lower past this low, which is also a breaker, I might point out, a high, a low, a higher high, and then a lower low. Once we trade back inside this range here, we want to see selling pressure or the algorithm actually start to take sells. So we are on side with smart money because we have an inversion gap as well. And if we take a sell from here, because we're taking a sell from here, you could technically place your stop loss at the start of this fair value gap, as we don't want to see it return into it because smart money have already offered sell side and given institutions a chance to actually sell. However, for this example, I would actually place my stop above the body's highs or above the breaker in this case. Our breaker starts there and that's where my stop loss would go. I would then aim for the lows down here and that would give us our trade. So the fair value gap, which was once used for buying, we want to see it traded through and then we want to see it respected on the other side of the market when we head lower. So that brings us to the end of the video explaining fair value gaps and the different types of these. I hope you did find this useful, and if you did, please do leave a like, subscribe and leave a comment. You can find my social links in the description. I'm always posting on Twitter and in my Telegram. So if you want to learn more from me and dive deeper into my content, please do click those links and check me out. And yeah, I'll catch you in the next one. Thanks for watching.